This AI predicted the 2023 market crash. Here's how. A year that shook the financial world like an earthquake no one saw coming, well, almost no one. While analysts scrambled to explain the chaos, one unlikely source had already seen it coming. An artificial intelligence model. Not a human economist, not a Wall Street trader, but an AI system, quietly running calculations in the background, months ahead of the crash. And what it saw. The warning signs, the shifts in sentiment, the subtle cracks in the financial armor that everyone else missed or chose to ignore. So, how did this AI predict the 2023 market crash before the headlines, before the panic, before the portfolios collapsed? And what does that mean for the future of investing, risk management, and the role of AI in the financial world? Let's rewind the tape and break it all down. To understand how this AI was able to forecast one of the most significant financial downturns of the decade, we need to look at two things: what exactly this AI was analyzing and how it differs from traditional financial forecasting models. Most economists and traders rely on macroeconomic indicators: GDP growth, unemployment rates, interest rates, inflation. But the AI that predicted the crash went deeper. It didn't just skim the surface. It dove into oceans of unstructured data, millions of tweets, news headlines, financial reports, earnings calls, and even satellite imagery. It wasn't just looking at what people were saying. It was analyzing how they were saying it, the tone, the sentiment, the changes in language patterns over time. Using natural language processing (NLP) and deep learning, the AI could detect shifts in market sentiment weeks before they showed up in any traditional metric. For instance, while earnings reports in early 2023 still showed strong numbers, the language executives used started to change, subtly less confident, more cautious, even vague. To a human reader, that might not raise any red flags, but to an AI trained on decades of financial language patterns, it was a red alert. Now, let's zoom in on the specific model at the center of all this. The AI in question was a hybrid system developed by a fintech startup specializing in predictive analytics. The system combined several neural networks, one focused on historical financial data, another on real-time sentiment analysis, and a third that mimicked decision-making under uncertainty, something like a virtual hedge fund manager. These models were trained on data spanning back to the 1987 Black Monday crash, the 2000 dot-com bubble, the 2008 financial crisis, and even COVID-induced volatility of 2020. But the key innovation, it wasn't just pattern recognition. It was causality detection. In other words, it didn't just see that X happened before Y. It tried to understand if X caused Y and if that same causal chain was starting again. Most importantly, it noticed an unusual spike in what it called contradictory optimism, a pattern where public statements from companies and governments remained positive while private data sources showed rapidly growing concern. This divergence was one of the model's most critical red flags. Historically, it had preceded every major crash. In December 2022, the AI assigned a 72% probability of a market correction, exceeding 20% in the first half of 2023. When investors and economists were still hopeful about a soft landing, this model was already calculating the likelihood of a hard crash. And then came March. The US housing market began to slow dramatically. A major European bank announced liquidity issues, tech layoffs surged beyond projections. One by one, the AI's predictions started coming true. By April, the market had plunged over 25%. Portfolios were wiped out, panic set in, and the AI, it was already updating its next forecast. Now you might be thinking, was this just luck? Did the AI simply get lucky, or was it really smarter than the rest? Let's talk about accuracy. Post-crash analysis showed that the AI correctly predicted 78% of major sector declines and 85% of individual company stock corrections above 15%. That level of precision isn't random. But it wasn't just about making predictions, it was also about the timing of those predictions. Because in the financial world, being early is everything. And here's where AI's advantage becomes clear. Unlike human analysts, AI doesn't suffer from cognitive biases. It doesn't fall in love with a stock. It doesn't ignore warning signs because of optimism or fear of missing out. It processes data ruthlessly, unemotionally, and constantly. It doesn't sleep. It doesn't wait for a quarterly report. It updates its model every minute, if needed. That's not just smart, that's superhuman. Let's dive into how the AI actually processed data. At the core of its engine were three things: natural language processing, time series forecasting, and reinforcement learning. With NLP, the AI could analyze earnings calls, Reddit threads, news headlines, even customer reviews. In real time, it could spot when a CEO subtly shifted language from "we're growing rapidly" to "we expect challenges ahead." That change, imperceptible to most investors, screamed caution to the AI. Then there was time series forecasting. The AI modeled historical data, looking for patterns that resembled previous crashes. But instead of relying on simple models, it used LSTMs, long short-term memory networks that can remember sequences over long periods. This allowed it to detect early signals of economic slowdown. And finally, reinforcement learning, an AI technique inspired by how humans learn through trial and error. The model would simulate thousands of market scenarios and optimize its decision-making over time. Every crash it experienced made it better at predicting the next one.